Two men, same age, same company, same position, same salary. For nearly 10 years, Jake and Michael had lived almost identical lives. They sat a few desks apart. They earned the same paycheck every 2 weeks. They celebrated the same promotions. Then one Friday afternoon, their manager walked into the conference room with a smile. "Congratulations, gentlemen. You've both been promoted." The raise wasn't life-changing, but it created one important question. What should they do with the extra money? They both made what seemed like the smartest decision possible. They decided to invest. 20 years later, one portfolio was worth nearly $1.8 million. The other hadn't even reached $700,000. The shocking part? They invested almost the exact same amount of money. The difference wasn't luck. It wasn't intelligence. It wasn't even the investments they chose. It was one invisible decision that millions of investors make every single year. The following Monday, Jake walked into work excited. "I've been researching all weekend," he told Michael. "I think I found the next big opportunity." His phone was filled with YouTube videos, market predictions, financial podcasts, social media experts. Everyone seemed certain they knew which company would become the next giant. Artificial intelligence, electric vehicles, biotech, clean energy. Every headline promised extraordinary returns. Investing suddenly felt exciting. Michael smiled. "I did some research too." Jake leaned forward. "So what are you buying?" Michael shrugged. "Probably an index fund." Jake laughed. "That's it? No exciting companies? No hidden gems?" Michael shook his head. "I don't think I need one." Jake couldn't understand. "You finally have extra money, and you're buying the average?" Michael smiled. "I'm not trying to beat everyone else. I'm trying to beat the person I'll be 20 years from now." Jake smiled politely, but deep down, he thought Michael lacked ambition. Who wants average? So they both invested. Jake built a portfolio full of companies everyone was talking about. Michael bought a simple low-cost index fund and set up an automatic investment every payday. The same amount. Every month. No matter what. Then life moved on. For the next 3 years, Jake looked like a genius. His investments soared, some doubled, a few tripled. Every lunch break became another opportunity to check his portfolio. His coworkers started asking for stock tips. Even family members wanted advice. Jake loved it. Success made him feel smarter. Meanwhile, Michael barely checked his account. Every payday, money quietly left his checking account and flowed into the same boring investment. No excitement, no predictions, no celebration, just consistency. To Jake, it looked like Michael wasn't even trying. Then life happened. Jake became a father. A few months later, Michael did too. The joy was the same. The sleepless nights were the same. The daycare bills were definitely the same. Suddenly, investing wasn't just about making money. It was about protecting a family. Jake began checking his portfolio every morning. Every market move suddenly felt personal. Then one Tuesday, the market fell sharply. News anchors calling it the beginning of a major correction. Experts argued that worse was coming. Jake couldn't concentrate at work. His investments kept falling. Every notification increased his anxiety. That evening, he sat silently at the kitchen table. His wife noticed. "You've barely spoken." Jake turned his phone toward her. "I've lost nearly $20,000. She looked at the screen, then back at him. "Did you actually lose it?" Jake frowned. "What do you mean?" "You still own the investments." He nodded. "So the only thing that changed is today's price." It made sense, but fear rarely listens to logic. The next morning, Jake sold almost everything. Just until things settle down, he told himself. It'll be safer. Across town, Michael watched the same news. His investments had fallen too. But instead of opening his portfolio, he opened his calendar. Friday, automatic investment. Still scheduled. His wife smiled. "You're still buying?" Michael nodded. "The market is on sale." She laughed. "You say that every time prices fall." "Exactly," Michael replied. "I've never complained when groceries went on sale." "Why would I complain when investments do?" Friday arrived. His automatic investment went through, just like every other month. Months later, the market recovered. Then it reached new highs. Jake finally felt confident enough to invest again. But there was a problem. He had sold when prices were low and bought back after prices had already recovered. He never noticed the damage because it didn't happen all at once. It happened quietly. One emotional decision, repeated over many years. Every market decline became another reason to pause investing. Every recovery became another reason to wait. Without realizing it, Jake wasn't losing to the market. He was losing to his own emotions. Michael never found the perfect investment. He never predicted the next big company. He never beat the headlines. He simply refused to let fear make decisions for him. Year after year, his investments continued growing, not because he was smarter, because he stayed invested when it was hardest. 20 years passed. Jake and Michael were both preparing for retirement. They met for lunch at the same diner they had visited for years. Jake smiled. "I spent 20 years trying to find the best investments." Michael smiled back. "And I spent 20 years trying not to interrupt mine." They laughed. Then Jake looked thoughtful. "You know what surprises me? I wasn't wrong about many companies. I was wrong about myself." He realized something most investors never do. Choosing investments isn't the hardest part. Managing your emotions is. By retirement, Michael's portfolio had quietly grown to nearly $1.8 million. Jake's was worth less than half that. Not because Michael found better investments, not because he earned more money, not because he had secret knowledge, because he built a system that didn't depend on how he felt. Most people think successful investing is about finding the next big winner. But history tells a different story. The greatest investment advantage isn't picking better stocks. It's making fewer emotional decisions. Markets will rise. Markets will fall. News headlines will change. Predictions will come and go. But discipline compounds just like money does. Jake and Michael earned the same salary. They invested nearly the same amount. The difference wasn't the market. It was the moments when fear whispered, "Do something." And one of them listened. Before you search for your next investment, ask yourself a different question. Do I trust my strategy or only trust it when everything is going well? Because wealth isn't built by predicting tomorrow. It's built by consistently doing the right thing even when tomorrow feels uncertain.